Right guys, welcome to the next episode of the FVT Trading Bootcamp. And in today's one, we're going to be discussing market ranges. So we're going to look into the Fibonacci, we're going to look into drawing a dealing range, how to draw these, how I draw these, which dealing ranges are important, how to combine dealing ranges with fair value gaps, a few other bits and pieces. Now, if you're new here and this is the first video you watched, I would recommend going back and watching the others. If you're not yet in the free Discord, join that because I'm going to have a forum where I post each of these videos and you can actually comment underneath that. Even in this video, right? Comment underneath, I'll respond to all the comments. That's completely cool. Now, I want to do some illustrations first, then we'll start on the higher time frame and then we're going to dig back down into the lower time frame because using ranges is a very basic concept. ICT, yes, he does talk about it, but it's not his concept. And that's why I tell people the way I trade is ICT, but I incorporate other concepts that have been around for a lot longer than smart money concepts. This is how I do it. Now, let's say we've got a market and we'll start off very easy. Market's doing this, like this. We've got a swing high up here and we've got a swing low down there. Now, in this situation, I want to firstly point out that there are bigger ranges and there are smaller ranges, right? So the bigger range or the biggest range in any market, and then we'll apply this to the live charts. The biggest range is essentially just the highest high, which I'm going to mark it in blue, and the lowest low. So the overarching principle that I want to actually get over or across in this video is that when the market is at the bottom of a range, I'm more so looking for buys. If the market is at the top of the range, I'm more so looking for sells. Now, there are little bits and pieces that will make me go opposite to that, but most of the time, 95% of the time, if we're at the bottom of a range, I'm looking for buys. If we're at the top, we're looking for sells. Now, in any given range, and you can start off by drawing a rectangle like this from top to bottom, mark out the halfway point, and we're going to start with discussing that first. Now, with your Fibonacci, that's the tool like this. You click, you drag, and then you release down here. And all I want to discuss now is equilibrium. Equilibrium, some people call it the medium point, equilibrium, consequent encroachment. It doesn't matter. It's all the same thing. It's just the middle of an area, the middle point of something. And, you know, we talked in the previous lessons about using the middle point of fair value gaps in different quadrants. You can do the same thing with this. Now, what often I like to do is if we're down here, I look for longs. If we go up here, I'll wait. If we're up here, I look for shorts. If we break, I look for shorts. So I'm going to repeat that. If we're at the bottom of the range, I look for longs up until 0.5. If we're at 0.5, I usually hold off. If we're up here a little bit more, I look for sells. If we come up here, I look for sells. This is really important to understand. I'm going to do the same thing now for a bearish market and a bullish market, just so you guys can see. So let's now draw the opposite, right? So let's draw a swing low. The market goes up like that, forms a swing high, comes down like this, right? That is also a dealing range. That's a dealing range too, right? So we can mark out a square. You can use a gun box too, but I'm just going to do this for the sake of the video. You can mark out a square, rectangle, same. And then you can also grab your Fibonacci and do a similar thing like this. Now, ask yourself, based on what I just said, if the market's up here, am I looking for most of the time a short or a long position? Am I looking for a short or a long position? A short. And the reason for that is that the market, guys, it likes to rebalance ranges, and that's a really big way of how I trade. We've talked about before, even when the market's trending up, we need to come down, and then we might continue. So you've got to first appreciate that there's different ranges in the market. There's a bigger range, and then a smaller range, and then a smaller range, and a smaller range, and a smaller, and a smaller, and a smaller, and it goes on and goes on and goes on and goes on. But you start with a big range first, right? Now, in this example, there's also smaller ranges. So for example, I could draw a Fibonacci from this high to this low, right? I could draw a Fibonacci from this high to this low. I could draw one from this high to this low, which is what we just did. Don't overcomplicate it. Start with whatever range we're currently sitting in. So for example, if the market was sitting like this, ideally I would have preferred to get a long from down here and trade into this top portion of the range. Now, what matters is what's above. If there are clear draws and liquidity above, then I'm also going to treat this as a little pullback to continue higher. However, if these draws on liquidity aren't very strong, then I'm also going to think, right, that price will roll over here. So there are times where down here I look for a short, but notice that where price is now, it's actually in a level, not at the bottom, but it's at the top. It's called premium. The top above 0.5 is called premium, below is called discount. Premium, discount, premium, discount. So notice how there's different ranges, and there's different trades that can be phrased within each range. So for example, let's remove this. The market sits here. We've talked about fair value gaps. Price taps into a fair value gap here, right? Say it's a 15-minute fair value gap. Great. Say this is a macro. Great. Say we invert a fair value gap here. Great. We can look for a long position. That's one of my entry models, right? Now, you can go for a long position. This is one trade, right? Along from here, stop goes there, and you target the top of this range. Does that make sense? You target from this smaller range, the top of that. If price is sitting up here, right, it's better to wait for a pullback first and then look for a continuation. So I'm going to repeat that. At the very bottom, you take that reversal. But if we're up here in this part of the range, it's better to look for a reversal or a pullback, sorry, and then a continuation. And the same goes for the next range. If we pull back and we continue, you can take a trade. If we're up here, don't long that up here. Don't do that. Wait for a pullback and then take a long. Again, notice how on these pullbacks, we're pulling back into this range, pulling back into this range. Wait for those pullbacks. Wait for more liquidity to be generated. This is a big thing that people get wrong, and they overcomplicate it. Just look at where the market is where you're trying to trade, and trade towards the opposite part of the smallest range, right? Have an idea where the big range is, but trade towards the opposite part. Now, we can apply this to the charts. So, for example, right, we can mark out this low, and I'm on the 15-minute chart. I like to use 15-minute charts to find my ranges. I don't really go any higher time frame than that. There's no need, in my opinion. So that's your range high and that's your range low. And you're going to have to do practice into this. That's really important. So if you're really unsure about how to draw ranges, join the Discord again, post some stuff in there. The community will help you out. That's fine. So this is a range here. Now, with that range, what can we do? Let's do exactly the same thing that we did before. Let's draw a rectangle from, bottom to top. Let's change this, move this up a little bit. And then with that, let's draw the Fibonacci on top. And what did I say? Look for the equilibrium point. Look for the halfway point. What does price do right here? And this is the range really like that. What's price do? It taps onto equilibrium, and what's it do after doing so? It expands higher. Right, so this is the starting of discussions into ranges. It's really important. And the market's going to move from up here, premium, back into discount, and then back into premium. At some point, this is really important. At some point, this range that we've drawn out has or is going to break. If we go up here today and sweep, the all-time highs, we no longer use that range. Does that make sense? We no longer use that range. If price comes down like this and sweeps that low, we no longer use that range. Get rid of it. Does not matter. But notice how this is the bigger range. We're trading back into that here. But then notice how there's also another range from this high to this low. And notice how we come back into discount, and now we're coming back into premium. So what do you think I'm going to do here at equilibrium? Go back to this example. Nothing. Don't trade it. Don't trade at equilibrium. It's too risky. Don't do it. Can you? Yeah, but it's too risky. So a big part of how I trade, premium discount. If the market is in a level of discount, I'm looking for a long most of the time. If you don't take a long from here, then guess what? You've missed out, and you just have to accept it. Simple as that. If the market is, pushing up here, and say we're at the top here, one reason I'd be very, fearful of taking a short up here. Why is it the case? Because we've got 1, 2, 3 low resistance liquidity highs. And the market is very bullish. Again, go back to market structure, relative equal highs here too. The market is bullish. So in a bullish market, what's the market going to do? It's going to pull back to go higher. So you've got to understand that market structure that we talked about earlier on. You've got to understand that. If we're bullish, yes, we're going to pull back. But just because we pull back into the top of a range doesn't mean it has to reverse down. especially when there's very clear draws on liquidity. Sometimes it does, yes, but sometimes it doesn't. And that's where you've got to kind of make a distinction and have a model, which we'll talk about, that allows for a bit of flexibility, but you're not doing too much. You're not, going too extreme. That's really important. So that's really important there. Now, we can go to different parts of the market and I can show you exactly what I'm talking about. So the market's trending up, right? This here is the range from low to high. That's the range. So what do we do with that? We pull the Fibonacci on that like this, and you can see price dips below 0.5 and then pushes. This is where you want to be going long, down here, not here. If you enter there, it's still okay, but the best longs come from discount, the best shorts come from premium. And you might say, well, why didn't it go down here, Ruben? We're in premium. Well, because the market is bullish overall, and this is just a pullback for the market to move higher. So once the trend's initiated, and you'll see that, you can see we're trending. If we're doing this and we do that, right, the chances are we're just going to keep moving higher. So if price trades up to this area like this, yes, that's premium, but it's not likely to do that. It can, but it's not likely. It's more likely that we pull back like this and we continue higher. That's the most likely scenario. Does it sometimes switch? Yes, but most of the time, that is what we do. And, dealing ranges is a big part of how I trade. So here's another example. We've got a swing low there. That's a pretty prominent swing low too, but let's do the major range like this. You can see what the market does from swing low to swing high. What's price do? It comes below 0.5. It sweeps a level of sell side and then it reacts. This is where you want to go long from, right here. That's the best long position, right? And the same goes for shorts. Like it all depends on how you build your narrative and how you build your bias. But ultimately, yeah, when we're in premium, look for shorts. When we're in discount, look for longs. That'll probably get you out of most trouble. It's not going to work all the time, as I've shown you, but that'll get you out of most trouble in terms of the market. And, if you want an easy bias, just look at the previous range. That's my advice. Like same here, high and low, right? When price is above 0.5, look for shorts up here. When price is below, look for longs. Again, we could do the same thing. We can grab a range like this, and there's different ranges, right? Different sizes from low to high. Short down here. Down here, look for longs. Then when we come back up, there's a new dealing range, right? There's a smaller range. It's this, from this high to this low. Cool, and then we pull back down. When we pull back down, where's the nearest range? From this high to this low. So what do? Pull back down. Okay, you look for a long. Where's the nearest range? From this high up here to this low. But notice in this case now, what do? Price comes up above 0.5. Maybe you can take a little scalp here to go short. That's okay still. Again, you can counter trend scalp. Most of the time, you can at least get a counter trend scalp in. But what's price ultimately do? We break past this high. So guess what range I'm going to use? Guess what range I'm going back to? This bigger range. As soon as we break past that high, I'm going past this bigger range. And when we break past this high, what range am I going to use? Zoom out again. I'm going to use now this bigger range. Does that make sense? And now I've swept. This is the thing. You've got to start with one and then build and then build and then build. Now we've swept buy side liquidity and we're in the top of the bigger range and then we sell off. And then when we sell off, and I'm going to keep going, right? Because you've got to understand this. When we sell off here, what range am I looking at when we sell off? Well, that range is no longer important because we're moving down. So we need to look at the previous leg up. I'm looking at this range. Okay, but the market breaks that range. So what am I looking at? This range. Does that make sense? And the same thing as the market starts to push back up. When it pushes back up here, I'm then looking from this high to this low. So you can go for a short here, back down to equilibrium. Here, go for a long. We break this high. Okay, guess what range I'm going back to now? Again, I'm using the same bigger range. So some ranges, the big ones, you're going to use multiple times. The small ones, probably not. Right, then you can see price breaks down. And this is the process that you need to do. You need to, for yourself, look at the markets and look at the charts and mark out these ranges. It's really, really important. So if you're watching this video, what are some actionable steps so far? What can you action straight away? Well, you can practice marking out dealing ranges. You've got to practice that. Practice following price with your cursor like I've just done. Join the Discord and post this so people can help you. And that's a really important part of it. and go back in the chart and have a look at how price respects dealing ranges. So I could start at any point in time. I'll just go back, right, on the 15-minute chart. This is some stuff I was doing before. Let's go back and back and back and back and back and back as far as I can go. Let's just go here, right? And let's just go back to a random point in time, right? Let's go here. Cool. And let's say this is when you hop on the charts. You hop on the charts, you're about to trade. This is PM session. Maybe that's the session you trade, right? What would I do? I'd zoom out. And this is what I personally do. I'd mark the dealing range like this. From swing low to swing high. To the last major swing points, okay? Price comes below this dealing range. What's best to do down here? Look for longs. What's the market do? Mucks around, comes up a little bit more. As it's kind of projecting up like this, what's the nearest range? This, from this swing low to this swing high. Cool. So notice how there's a switching point, right? And then now we're at the top of that range. Are we going to respect that range and come back down, or are we going to move higher? We're kind of hovering around that point. Okay, we've kind of come back down now. So we've come back down. What's the nearest range? The nearest range is from this low to this high. Okay, we've come to equilibrium. Are we going to bounce from here, or are we going to reverse? Eventually, we're going to break out of these ranges. We have to, right? So we start to respect the discount. And now what happens? Look, we sweep. Do we sweep that high? We sweep that high. Perfect. So when we sweep that high, we can no longer use that range. We need to zoom out. What's the next biggest range? Oh, it doesn't exist. So in these situations, when the price is breaking past a range like that, I don't like to trade. That's a really important thing. And if you made it this far, that's a bit of a lesson, right? If we've broken past like an external range, I don't like trading because there's nothing to work off. I don't like that. And what I like price to do in these situations is often this is where you're going to look for like massive reversals. So there's no range to use. We have a nice massive reversal there. What's price do? I mean, this might have been all-time highs potentially. Could be that. Notice how here we're just mucking around, right? There's internal ranges too, but here's the thing, guys. It just depends when you're trading. That is the biggest thing. Whenever you hop on the markets, that's when you should worry about the range. Don't worry about what the market's going to do in 2 hours or 4 hours or 5 hours or 6 hours or the next day. Don't worry about that. Don't predict the daily close. Don't predict where the week's going to close. Who cares if it's a TGI setup? Who cares if it's a certain market profile? Who cares? What matters is probability. What matters is seeing the ranges, and then whenever you're trading, that is when you're concerned. Don't be concerned about predicting, please. Not going to work. Right, but you're going to see how the market uses these ranges. We've got the range low, we've got the range high. We come below, cool. Then we got this range low and then this range high. We come above. We sweep a range high, an external range high, like this. We expect to have a little reversal, but it's not usually something I participate in, very rarely. Now, same thing, we go back here. What's the market doing? The market forms a swing low, we trend up, we form a swing high. Comes back down, cool, it pulls back into this range from high to low. Comes back down, pulls back into this range from high to low. Now, keep in mind, as the market's coming down like this, I'm also thinking about this bigger range from low to high. Like I've got that in my head. So anytime we're above here, when we pull back, shorts are good. When we pull back, shorts are good. When we pull back, shorts are good. These are really nice trend continuations. Once we come below 0.5, I'm also looking for longs. And once we come into a deep level of discount, 100% I'm looking for longs. Does that make sense? That's really important. So when you have a market that is impulsive and comes back down, you kind of look for shorts until we come below 0.5, and then you look for the opposite, is the way to put it. And sometimes you have situations like this. It's a similar situation. So you've got, a range high now and a range low. That's the impulsive move. So we come down like that. Imagine the halfway point of this move, which I'll mark it out. Look for longs up until we reach halfway. So, down here, look for longs. When we come back down, look for longs. But by the time we're up here, just let it do its thing. Let it do its thing. Otherwise, you're probably going to get caught up. And this is how if you want an A+ setup, you're looking for things in a higher time frame range. And then what we do is this. The market now forms a new range from this low to this high. We're trending up. We drop. Where do we drop down to? Well, swing low, swing high. below equilibrium. So that's where you look for a long. If you miss that and we react like that, well, you're probably gonna have to look for a continuation. And you'll see this happen time and time again. The same thing, right? This is some analysis from a while ago. But look at the bigger range first. Look at where we are in that bigger range and then narrow that down as time goes on. So for example, swing high, swing low, right? Very choppy, but we're moving down like this, right? Boom. So mark out the equilibrium of that point from swing high to swing low, bang. And where you want to look for longs is from down here. Now you might say, well, what's the turning point? The turning point is when you sweep some kind of liquidity and you need to have a reaction down here that means something to you, down at this point, right? This is where you're looking for an inverse fair value gap. And that will be the indication that we might be switching from this range to this range. Some people like to call this, external liquidity to internal, whatever you want to call it, doesn't matter. It's just range to range. And the indicator for me as to when we're probably switching from one range to another range is like an inverse fair value gap. If we do that on a higher time frame, I'm pretty confident at this point on this candle here, right? On that candle there, I'm pretty confident that at that point we should, or more likely to, I should say, on this candle close, more likely to at least go to equilibrium, so I look for longs. When we're up here, I'll wait for liquidity to be swept and then look for shorts. If we don't sweep the liquidity, we don't sweep that high, then we wait for the pullback and then we go for that continuation. So there's little bits and pieces here that you're gonna find, and you're gonna have bigger ranges, smaller ranges, like even in this market here, as the market trends up, we don't always have to pull below 0.5, but that's where the best trades come from, right? Under here, this range from low to high. Maybe you look for a long here, but it's not below 0.5. You can still take it, but it's not as good. This is another range here. Sweep liquidity, 15-minute fair value gap, beautiful, nice and easy, and the list goes on. So, bit of a longer video today, but I thought I'd talk about dealing ranges in a little bit more detail. Right, you need to understand the concept of premium and discount. And again, just to recap that, when you've got a range, right, like this, and when you do the both scenarios, we'll do the equilibrium like that. Anything above, right, this is premium. Anything below, that is discount. And essentially, when you're in discount, you look for a long. When you're in premium, you look for a short. Now, there's also smaller ranges, like I said, so we can pull back here, you look for a long, pull back here, look for a long, but as soon as we come above 0.5, just let it do its thing. Don't long. The best case scenario, you're gonna look for a short when you're up here. Price comes down like this, look for a short. Price is in here, look for a long. If price sells off, who cares? Look at the next range, because we could bounce from that. So it's a process of elimination, because there's so many potentials that could happen in a market, and that's what a lot of people it confuses people, but you just got to worry about what's happening at the current time you're trading. So let's do that again. Let's say the market's here. Let's go through all the possible scenarios, right? And then I'm going to end this lesson. So the question for you is, are we below equilibrium here? And this is the basics, right? There's more to it than this, which we'll get into as we go through, but this is the real important stuff. Are we in discount or premium? Where my cursor is that discount or premium? Discount. So are we looking for a long or a short? Long. Cool. So we're looking for longs ultimately anywhere from here to there, right? Anywhere from there to there is going to be a long. How you enter that long doesn't matter. It could be a reversal, the initial reversal. It could be price trades up, pulls back, and then you look for a long. Pulls back, and then you look for a long. What are we doing now at equilibrium? Are we taking a trade at equilibrium? Are we trying to flip a coin? No. At equilibrium, just wait, right? So when you're in the bottom of a dealing range, look for longs up until equilibrium. It doesn't matter if you catch the initial reversal or if you catch something up here, like an inverse, or you wait for a pullback and take the continuation. Take longs to equilibrium. The lower down in the move you enter from, the better. If you can enter here, great. If you can enter there, it's okay. If you enter up here, it's a bit more risky because, again, every time we tap above and below 0.5, there's a chance that the market does this and then reverses. So you want to be well out, ideally, before you even reach the halfway point, ideally. All right, so let's say the market trades up here. What are you looking for? Shorts or longs? Shorts or longs? Shorts, right? Now, the market could do this. The market, let's reverse that. The market could go down like this. The market, what else could it do? It could bounce from here. That's the second option. We'll label that in blue. The third option is the market goes down like this, bounces from here. And the fourth, we're going to label these all different colors. The fourth is that it just keeps going higher. Now, each of these scenarios actually yields you an opportunity, but people confuse themselves. People overcomplicate it. Take one thing first, and then if one of these other scenarios happens, then worry about it. So when the market is sitting, I'm going to make a little highlight here. When the market is sitting here, I'm looking for a short. Simple as that. Nothing else, I'm looking for a short. When the market is here, I'm looking for a long because we're below 0.5. When the market is here, I'm looking for a long. If the market is here, I'm looking for a short. If the market is here, I'm looking for a long. So notice each of these points in market structure, in ranges, they yield long or shorts. And so in a given session, you might have longs and shorts given to you. That's the important part. So for example, let me just remove some of this stuff. You might take a short position like this, you take a short, and you want price to sweep this low and sweep this low. But the way I trade on my model, you don't need that to happen. You can make money from going here to here. Take a partial, hold a runner. If price just goes here and reverses, it doesn't matter, you've made money. And that is how your system should be based. You should be able to be wrong or somewhat right and still make money. If you're demanding that the price goes down here or here to make money, good luck to you. That's all I'm going to say. So you need to have a strategy that actually makes this possible. And that's what I teach, right? So that's what I'm going to be teaching, obviously, along these lessons. So focus on, this is really important, focus on where you're sitting in that range and then go from there. And you have to, right? You have to go back in your charts. I know it's a long lesson, but this is a really important one. You have to go back in your charts and you have to chart things out. You have to go and go, look, yep, I see price reacting from this range and reacting from this range. You have to do that. You have to. Please, 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 please. Don't come to me. Don't come to the Discord without putting in the work before. And then when you've put in that work, ask questions about the work you put in. Like if you're taking screenshots and you're not sure about something you've done, then do that. You know what I mean? But put in the work because you need to understand. Now, let's assume you trade the New York session and this is where you hop on, you look for a short. Let's assume you trade the New York session and this is where you hop on, you look for a long. If price is sitting down here, you look for a long. If price is up here, you've just swept the high, you look for a pullback into the range. So notice how at each different point, we could label them different things. We could label this A, we could label this B, we could label this C, we could label this D, we could label this E. Each of these points is a different trade based on market structure, right? Some are short, some are long. This one is short, this one would be short, this one is going to be a long, this one here, sorry, is going to be a long, this one's going to be a long, this one's going to be a long too. And in any given session, you're going to have multiple opportunities to use this. So a bit of an in-depth lesson here, starting off with the basics, but you need to understand premium discount, number one. You need to appreciate that, we're going to pull back in a market. We can't just keep going up and down forever. And you need to draw these things out and understand that in any given dealing range, there's going to be so many steps to take. So focus on the ones that are in the higher time frame range to limit getting chopped up in the 1 minute chart and whatnot, because ideally you want that to be a 15-minute range. And then these little ranges are 1 minute ranges, but it's better to use the 15-minute range, to use the bigger range first and then move on from there. Does that make sense? Again, guys, hope you enjoyed this video, a bit of a longer one. Until next time, we'll talk then. We've still got many more videos to come and episodes in this series. So if you like, let me know below. Any questions, join the Discord, post your things in there in the forum, and we'll talk very soon. All the best, guys. Happy study.